Well, hello everyone. Thank you for joining us for our latest installment of our peer analysis and balance sheet strategies update. I am Andrew Palillo, and happy to have with us here today uh, Derek Hamilton, who joined us recently as a senior financial strategist here at the bank. And he's already hit the ground running, done a number of things for us here internally on their team. And we're very excited to have him out there as another face and voice to be working with our members. And as we were looking for another host here, I have to say, full disclosure, Derek, we did have feelers out, in the Olympic spirit to Snoop Dogg and Martha Stewart, given their involvement with the Olympics and the U.S. Olympic team. But unfortunately, I did not hear back. So, we'll make do with what we got, right?
Sounds good.
For those of you who've been with us for these quarterly webinars, you know the drill in the three areas that we'll talk about here. But for those who are new, and then there's a lot of new folks, I think once again we had a record number of registrations and attendees, which is fantastic to see. We're very appreciative of that. Um, so we'll start things off talking a little bit about drivers and things happening in the markets and the economy. We'll then take a deep dive into what's happening on our member call reports here in New England. And then lastly, we'll talk about some actual things that we can put into effect on the balance sheet strategy side. So we'll kick things off. We haven't done a poll question in a while, but I think given the all the discussion and the uncertainty about what is happening with the potential for short-term rate movements. So, you can see the poll on screen here, and we'll launch it in just a moment here. And bear with us as GoToWebinar recently upgraded their systems here. So you may see the layout a little bit differently. Um, but bear with us 1 second as the poll begins to go through. But you can take this time to think about what your answer may be. So we have three rate cuts left for the rest of 2024. Excuse me, three Fed meetings for the rest of 2024, September, November, and December. Curious to see what people's opinions are as to what and how many rate cuts that we have. And we can have the different options outlined below. And for the purpose of the poll, we'll talk about 25 basis point increments. So a 50 basis point cut would really be two. Right now, what is being priced into the market, and it ebbs and flows every single day, it's about 90 basis points of cuts, so just a little under four cuts. So there's still an expectation that in one of these meetings there will be a 50 basis point cut. I won't, personally, I won't entertain the idea or the possibility of a cut occurring in between meetings. I think that's a little silly, in my personal opinion. A weekday or a week for the stock market, in my opinion, doesn't justify a uh, a an intermeeting cut in rates. Having a little difficulties getting the poll up, but that's okay. We'll keep it moving forward because fortunately, I took a stab at guessing what the results of the poll would be, and keeping with the Olympic spirit here, some visuals as to what we thought. Maybe not necessarily what people think is going to happen, but I think what banks and credit unions would like to see happen in terms of the rate cuts here. And so you can see the Steph Curry and the men's basketball team probably shooting and making that shot over some outstretched arms. I think that shot did actually go in. It was one of the many the 9 3-pointers that he hit, and that rate cuts would provide some relief for our balance sheets and our income statement. And then out of the three, and we'll get back to this in section 3 in terms of the different scenarios here: a soft landing, a hard landing, or higher for longer. I'm going to go out on a limb and say most are rooting for some version of the soft landing. And when it comes to predicting interest rates compared to Katie Ledecky in the 1500 meter race, she doesn't lose those very often when there's that type of lead. Although with interest rates, it's anybody's best guess. We have seen crazier things than comebacks from that type of a margin. So let's jump right into talking about markets and economy. Actually, there's our poll. So feel free to, we'll give it a minute or two, and we'll see what everybody's guesstimate is as to what you think is going to happen over the next couple months. Okay, I know we can see it here on screen here, and it's coming in, kind of, sorta, what we're handicapping. Okay, we got a bulk of the answers in. We'll just give it another few seconds here. Okay, Stacy, I think we can we'll wrap it up and see what the results may be. So nearly 2/3 of folks think that we're going to see 2 to 3 cuts. And as we talked about before, that the expectation as of right this moment is a little under 4. That kind of makes sense. And in terms of the assessment of what may happen over the next couple months. Not to say we didn't even begin to talk about 2025. That's a whole other ball of wax. But no, this is good insight and a good kickoff for what we're going to talk about here with the yield curve. So we've seen a real sea change over the last few months in terms of what the market expectations are for future short-term rates. And really there seems to be conviction that this time rates will actually be getting cut. Not to be confused with the half a dozen head fakes that we have seen over the last year or two. So what we're looking at here is 3 different versions of the steepness of the yield curve. And you'll notice that we're not talking about the 2s, 10s, which I don't think is really all that applicable for depository institutions. But the combination of tenors that we have here are really indicative of the short, medium, and long-term horizon for potential rate cuts. And I'll just pause for a second that if anybody has any questions at any point along the way, you can enter it into the chat module and we'll address it as they come or at the end. So we've seen the moves in the short term at the very front end, the 3-month to 6-month. We've seen that inversion of the curve. So that is the market beginning to really believe in the expectations of the cuts. The biggest change has been in the 6-month to 2-year range, where the 2-year has come down quite a bit, just about 50 basis points further of inversion. But interestingly, the 2 to 5-year spread has widened out a little bit. And I think part of the reason that we can point to there is that, as we kind of alluded to before, I think that the motivation, the catalyst for what really changed this, there wasn't this one big moment, right? It wasn't the failure of a large institution or anything like that. It's just kind of been the slow bleed of some weakening of economic data. And as I said before, a bad stretch for the stock market, yet still being up on the year, in my mind, doesn't justify a complete hard pivot in Fed path and direction. So Derek, why don't you tell us a little bit about what's happening in the mortgage space?
Yeah, so we've been seeing rates decline a little bit over the last year. You can see that on the graph as rates are moving down as expected. But one of the interesting things here is that the yield spreads are also tightening up a little bit. When prepayment risk is a bit higher, we're expecting larger spreads demanded by investors. But now that the prepayments are more bullet-like and the cash flows are more consistent, we're really seeing those spreads shrink, which is kind of changing the environment there.
Yeah, so for those members who are part of our mortgage partnership finance program and sell mortgages to us, we've seen a lot of activity over the last few months, and that continues. And there's a lot of drivers for that, liquidity conditions and rates and such. But when we do see moves in rates, and we've talked about this in prior webinars, that aside from current flow business, there may be some potential opportunities that are interesting from from the CFO treasurer perspective, not necessarily the secondary marketing manager perspective, to look at what loans are inventoried in portfolio, whether they're some of the ones at the higher coupons that have stuck around have not yet prepaid, or even some of those low coupons that have benefited from, as Derek said, the rise in rates. So maybe the discount or the underwaterness. I always make up words here. The underwaterness of the price of those loans has come back a little bit as rates have rallied.
Yep. So another thing that we were taking a look at was the spreads for credit. Typically, a good indicator of what's kind of going on in the economy here. We're noticing on the investment grade credit, the spread is widening a bit. So not necessarily something to worry about here, but it's something we're going to be keeping an eye on and see how the movement continues throughout the year.
Yeah, no, this is an interesting dynamic in that it's been happening more in investment grade credit as opposed to the higher yield, the greater risk segment of the market. So as Derek said, no panic button just yet, but it's something that certainly is on the radar. So let's pivot to talking about economic data. And those of you who have tuned in before, you know that one of my soapbox issues is the way that inflation is looked at. And I won't go on the full rant. I'll give the quarter rant here, and say that when you look at the percentage changes, and we saw the CPI release yesterday, that's not on the chart here. It's come down, it's normalized. But when you look at percentage changes on the heels of big percentage changes, big moves that we have seen in 22 and 23, there's almost an asterisk to that number. And if you look at the bottom panel, that shows the actual index level, the price level, index to 100 going back to 2021. And just as consumers, as businesses, we know that cost, maybe the rate of change is slowing down, but there's still the pricing pressure that impacts the goods and services that we have to live our life with. And I'll give a shout out. It's the summertime. We have our interns here, and our intern Omen was very instrumental in helping out with this slide and the next one, and digging into the economic data and looking at some of the industries that were the key drivers. And in the most recent CPI report from yesterday, energy prices down, but economists they omit food and energy because it's too volatile. It doesn't count, even though we all rely on food and energy. But the two biggest drivers that are really pressuring prices in the most recent report was transportation and shelter, housing cost. So that that aligns with what we're seeing with market prices for homes here in New England still. So talking about unemployment, this has been another economic thing that many have been pointing to think about, hey, maybe it's time for cuts to start happening. And we've seen some tick up in the national unemployment rate. That's exhibited by the gray area here. But closer to home, we want to look at what's happening here in New England, because that necessarily doesn't mean that what's happening at the top level tells us what we're seeing in our own communities. As is often the case, things here in New England are much more stable and consistent than what's happening on the broadest level. So the three northern New England states, the three lines, really have been quite strong and flat to coming down over the last year, where the national has been ticking up. Massachusetts, we've seen a little bit of a rise. Rhode Island has been ticking up as well, and Rhode Island is actually the only state right now that is above what's happening at the national level. Connecticut had been higher for a while, but has come down a little bit. So, there's our look at the Fed's two main focuses of unemployment and inflation. But here's another interesting dynamic that we've outlined. So this is looking at median hourly wage growth going back a couple of decades, almost 30 years here. And what I've annotated with the blue here is the 12 months preceding a technical economic recession and the 12 months at the start of that recession. And if you squint, you can kind of sort of see a little bit of a trend where leading into the recession, that metric plateaus a little bit. And then once the recession starts, it starts to come down a little bit. What's really odd and fascinating about the environment that we're in right now is that we're seeing that recession-like activity in terms of the decrease. Now, hopefully you were paying attention to 2 slides ago, where I said you have to put an asterisk where when you're looking at percentage changes when we see the big changes. So the same way I said inflation is not dead just because it's normalizing right now. Flip it around, median hourly wage growth is still strong. People's incomes are still high. They're improving. There's the wealth effect that comes with it. So let's move along to looking at what was actually finding its way onto balance sheets. So everybody's favorite topic. Let's talk about margin. And it used to be margin pressure, but now there's a little element of optimism here. I'm perpetually the optimist around here. So, but I didn't have to. You don't have to squint too hard to see some positive trends. So when here we're looking at the percentage of our membership base who are seeing improvements on a quarter-over-quarter basis in terms of a net interest margin, and we've highlighted the sections where banks and credit unions have been able to improve. And what we see is that for the first time since rates began to, at least since they stopped rising, and certainly since a couple quarters before that, the majority of banks not quite, but almost 50% of banks saw quarter-over-quarter NIM enhancement, and nearly 80% of credit unions were able to see improvement. Now, I'll temper some of that optimism and say that it's not all sunshine and rainbows yet, at least on the bank side, because on the bottom left-hand side, you can see that we're still we're still feeling the effects of the weakness of the last few quarters, that the median NIM across our membership base at 256 has come down a significant amount. Credit unions have held a little bit better, higher at that 328 level. So what's driving some of those changes? And it's the slowly but surely, it's the asset repricing. So on the left-hand side for banks, and we'll get the credit unions in a second, we're seeing that lift of the asset side of the balance sheet, whether we're talking about investments or different types of loans. And I recall we were speaking with a bank a couple weeks ago, and they said in the second quarter, the average loan that they put on the books was comfortably north of 7%, which is historically fantastic, and the spreads were okay as well. So whether we're talking about just the simple turnover, we're not getting much prepayment, but just the amortization is incrementally picking up, or even if it's growth that we're seeing in targeted portfolios, that those 1s and 3% yields are coming off and replacing with 5s and 7s. And on the funding cost side, we're seeing a little bit of maybe call it a plateau or decline, that some of the funding cost pressure is starting to abate. And we'll get to this in the last section, but when we look at the median cost on savings accounts and CDs at 418 and 161 for savings accounts, now we're in a position where CDs, you might even have some margin lift depending on where rates go, that we fast forward 6 months from now and you're able to go out there with a 4% CD because rates have come down a little bit. Well, you're going to get some funding cost relief. And we'll get to this in section 3, that savings amount, it's stabilized a little bit in that mid ones, and you can argue both directions that, hey, it's going to stay stable, or the pressure and the drift could continue. When we talk about credit unions, similar stories in terms of the asset lift, and I think the asset lift has been to a greater magnitude, and a big driver of that has been generally just shorter portfolios. In particular, talking about the heavy reliance on auto portfolios that throw off a ton of cash, and Derek's going to get into the growth or lack thereof perspective that certainly is a component here as well. And on the funding cost side, we can see the gradual decline in the rise of interest-bearing deposit cost and share cost. And they're still increasing, but again, looking to that rate of change or the magnitude of change certainly can be a valuable exercise. So we'll shift now to looking at what is the correlation, or where's the relationship between interest expense, and seeing if there's any common threads between those who have high interest expense and those who don't. And if you look at the top right, you can see an example of the groundbreaking analysis that we bring to you here at the FHL Bank Boston, that there's a high correlation between interest expense and the cost of interest-bearing deposits. So, what would you do without us to tell us that those two things are related? But we're not going to go into all of these metrics here. I'll just point out two things in particular that jumped out to us. And the first one is that the cost of savings and money markets has a higher correlation with interest expense than the cost of CDs. CDs have taken up a lot of bandwidth in the last couple months. The other part is that not the cost, but the amount of CDs that we have has a greater correlation than the amount of money markets that we have. So what that tells us, it's not about the rate that you pay on the CDs. It's about how much you have to have of them in the first place and how effective you have been at building that durable core deposit, non-maturity deposit franchise, that it's not just about the rate, that you're able to provide the service and all the other things that your customers need from you, independent of, hey, we can pay higher than the institution down the street. The other thing that jumped out to us is that we're looking to see if there was any kind of connection between, hey, the banks who have a certain emphasis on a particular loan type, whether it's CRE, CNI, or residential mortgages. There really was no relationship in terms of making that connection to say banks who had a focus on this type of loan sector saw more funding cost pressure than others. On the credit union side, again, I won't go through everything. There wasn't really much of a connection between higher interest income and higher interest expense. So it wasn't, there wasn't the logic of, hey, we're able to extract higher yields, either because of the types of credit we're taking or any other driver of that. And then saying, well, we can justify paying up for expenses because we have that great start in terms of capturing margin. That there really wasn't a relationship there. But where we did see a relationship, at least relative to what banks showed, was that a higher loan to asset ratio did tell us that we would typically see a higher amount of interest expense. So I think that speaks to maybe liquidity risk management more so than credit risk management being a driver of how we set deposit prices.
Yeah, so as Indra was saying, we've been digging through members' balance sheets, trying to take a look. And one interesting thing I found was the loan mix that's happening. So we've seen cost of funds rising. There's not much relief there. So a lot of the members are trying to remix their portfolios to try to get a better yield. And we're seeing that where banks are decreasing their residential portfolios as well as our credit union members, and trying to remix that with more commercial lending to increase that yield. It's a bit slower because the churn is a bit slower. There's no prepayments right now in the industry. Right. We see a little bit more with credit unions where the auto portfolios are getting paid down a bit faster. So it's slow, but it's moving. And this really shows an example of how that's actually working. So when you take a look at the banks, you can see that the residential mortgage business or residential loan business is a bit flat, not much growth there over the last several quarters, whereas the commercial side is actually trying to increase a little bit. Again, there's forces at play here. There's liquidity that people have to balance. There's funding issues that they have to try to balance, especially where it's tough building deposits. So that kind of explains why there's been a slowdown. There's not a steep spike in any type of loan movement, but there's a concerted effort to try to move that loan mix. But when we get to our credit union members, you do see that mix actually working more effectively, where they're not necessarily building out the auto portfolios anymore. They're either letting them maintain, since the volume needs to be much higher to maintain those, or even letting them shrink a little bit and shifting funding over towards commercial loans to try to capture that yield and relieve some of the cost pressure.
Yeah, so thank you, Derek, and it's interesting to reconcile the how and why these growth rates are coming down. And I think we can distill it to one or two sides. Is it the customer demand waning, or is it the institutions themselves trying to pull back a little bit more. And like everything, it's probably some combination of both of those two things.
Yeah, we've heard that directly from our members too. Some have a no growth plan, some kind of want to see how things shake out, and other people say there's not inventory there. So you're right, full mix of everything.
Yeah, and that's why we have to be cognizant and aware of the broader macroeconomic conditions, like we talked about in the section one, because certainly that has the potential to dampen the customer demand side, even if there is the liquidity and the appetite to grow. So, going back to the positive signs on margin, this is probably my favorite and probably the favorite of the people here in the audience here, in seeing some gradual positive shifts in the mix on the deposit side. Those CDs that we talked about. So here we're looking at the percentage of banks and credit unions who increased in the particular buckets quarter over quarter. And in light blue up top, we can see the retail time deposits. As we got to the tail end of 2022 into 23, pretty much everybody was growing the CD book. But we have seen that start to moderate, and that, as you can imagine, an analysis like this, 50% plus or minus a few, that is kind of the cruising altitude. When you see big jumps into the upper quartiles, that's when it really starts to tell you something, or the bottom quartiles rather. But the biggest number to me here is look at the non-interest bearing number. That has been challenging, certainly as rates are at 4 or 5%. Customers are trying to maximize every penny that they have, even in the transactional operational accounts. If there's any loose change floating around, get it into a vehicle where you can earn some incremental income. But that lift up, above 50% is a positive sign, certainly in connection with the decline in CDs. And that's a direction that I'd imagine pretty much everybody on this call would like to see. Credit unions, we have continued to see that decline in CDs, even at its peak in the end of 2023, a staggering 91% saw growth in that CD book. And then the non-maturity deposit, or the share drafts rather, there's kind of an asterisk here because there is a pretty clear pattern of seasonality where in the first quarter of the year you do tend to see a bump in share drafts. So looking at the second quarter numbers, can be a little misleading, but I think the biggest thing is to see that certificate and CD growth moderating.
Yeah, and there's good news in the investment portfolios as well. Seems like a lot of our members are starting to increase their investment yields. We have noticed some runoff there. They're not necessarily reinvesting back into the portfolio, but it seems like a lot of those pandemic era investments are starting to roll off or paying off, and the yields are increasing higher. So about 31% of our bank members are over 3% yield, and then about 58% of our credit union members are over 3%. So I think in the coming quarters, we'll have to start introducing some more buckets there as everything starts raising up.
I think we may be running out of shades of green or blue to do that. But again, for the new folks, if you haven't noticed, we've tried to keep it consistent with the formatting where banks are in blue and credit unions are in green. But we touched upon this earlier in terms of the autos producing cash flow and allowing for that faster repricing. Generally speaking, too, credit unions tend to have shorter investment portfolios, and also have held higher levels of cash as well. So part of this dynamic of the credit union yield acceleration really being pretty extreme in a good way has not just been the replacement, but it's also been the growth, right? Taking some of that, hey, maybe we were at 12% cash, but gosh, we can get 4 and 5% with modest durations and little credit risk. Let's convert that into the bond portfolio, and that is going to turbocharge the yield improvement as well.
Yeah. So when we take a look at the overall growth, we've talked about the individual products, but as we look at banks and credit unions as a whole, it's a bit of a different story. So when we look at the banks, they've increased a bit modestly, about 4% on median. That could be significance due to them being able to take wholesale funding more willing to take some funding to reinvest into either their loan portfolios to keep moving forward. put it in cash, their investment portfolio. They're more willing to do that. Whereas on the credit union side, the growth has been more, I don't want to say stagnant, but definitely less dramatic, being under 1% for median growth. And again, that could be a function of the higher turnover on auto portfolios, just maintaining that level, not necessarily shrinking at all, but they're definitely maintaining more rather than growing.
Yeah, Derek made a good point about wholesale funding usage. So I don't believe we have it directly here in any slide, but we certainly have seen, and there's two parts of that. Credit unions have been able to preserve deposit balances better than banks have, so they haven't had to backfill or increase the wholesale funding side of things, and also the loan growth has not been, to the same level. So there hasn't been the incremental need to tap the wholesale funding in order to meet that loan growth. So, as Derek said, more of a stable holding serve perspective as opposed to the bigger ups and downs. So, we talk a lot about the balance sheet mix and interest rate risk and liquidity and margin trends and pressure and all that. But we know that credit is always front and center. So everyone, it feels like since the last 4 years, everyone's been bracing for a storm that never really came. Certainly with all the uncertainty in 2020, in the fall in 2021, there wasn't really major any impacts in terms of delinquencies or anything like that. But if we squint, we're starting to see some isolated idiosyncratic increases in some of the credit metrics. So here we're looking at, for banks past due and non-accruals, specifically in the CRE space, just because that gets a lot of headlines. I won't go on a rant about office, Class A office, and the lack of applicability to community finance institutions. That's for another day. And then on the credit union side, looking at delinquent loans to total loans. So we have seen a little bit of a tick up in the percentage of banks who have past due and non-accruals in the CRE side above 3%, from 2 to 3 to 5 to 8%. Not a huge magnitude, coming off a very low level. But for context, there you can see the dashed line. We took a similar 8-quarter experience that we saw with in 07 to 08, and we can see the baseline was much, much higher at that time. 19% getting up to 29%. So directionally, just because the number's moving up doesn't necessarily mean that there's problems on the horizon. Credit union side, similar type story. We have seen a little bit of a drift up in terms of the percentage of credit unions above an arbitrary 1% threshold. But again, pales in comparison to what we saw in 07 and 08. And we've mentioned this in the past, talking about angles to come at credit. What we're looking at here is purely just the past due and the delinquents. It says nothing of reserves, which continue to be strong, again, because that credit storm never came. We built it up. We went through CECL. We did all that. And even that there's been some decent amount of reserve releases over the last few quarters, but still, coverage ratios, excellent. The ability to absorb potential losses, which may or may not come to the magnitude that the doomsayers are forecasting, but I think most are in a good position to handle any bumps in the road. So let's pivot over to the last section here, and we'll talk about some of the actual levers and things that we can do. So if we were in a world where high quality, good credit loans with sticky rate and sensitive deposits were all falling out of the sky in equal matching amounts, and we felt great about our interest rate exposure and all that, we wouldn't really have to worry too much about the path of rates. But that's not the world that we're in. So a lot of people have been talking and debating about where short-term rates are going to go, including us, who put out a poll asking for everyone's opinion. But I think what gets lost a little bit is what happens in that intermediate end of the curve, because that does have an impact on our balance sheet as well. And one of the things that I'm most concerned about right now is the possibility that as we start to see short rates go down, that the move in long-term rates, or intermediate, however you want to define that, but we'll call it here 5 years, that most of the move has already been done. So if we think about the environment that we've lived in for the last year or so, it's been really a suboptimal environment. The curve is inverted, which is not great for depository institutions. But on top of that, the curve is inverted, expecting cuts that never came. So the persistence of that inverted curve has lingered on for a long, long time. Well, what is the opposite of that? A steep curve where hikes never come. That, I'd imagine everyone on this call, if we put out a poll, I think we'd have consensus. I got 100% of people would love that yield curve environment. And that's what we saw coming out of the great financial crisis, 10, 11, and 12. The curve was super steep, and hikes didn't come until the end of 2015. So if we see short rates come down, if they come down 200 basis points, let's say, that will bring rates down into the low threes. Well, if the belly of the curve, the 5-year, does not move, well, there's not too much terribly slope there, right? 340, 330 or so to 370, 40 basis points of slope. Not exactly the optimal conditions. So if anything, I wouldn't be surprised if the move in the belly of the curve, in fact, moves up a few to 4%, 4.25%. So the recovery in value of fixed rate assets, the bond portfolio, the residential mortgages, just because short rates are coming down, I wouldn't write in pen that possibility for the same things that happen there in terms of the rate moves. Now, we don't love to be in the rate prediction game, but we have to be cognizant of the impact on balance sheets, in different scenarios. So when we think about a soft landing, a hard landing, or a higher for longer, there's a couple, key considerations as we slice and dice the different parts of the balance sheet or the different types of risk that we would look at. In a soft landing scenario, we talked a little bit about, what could happen with the long rates or the intermediate rates. Look at what we wrote here for credit and deposit growth. Not great, not bad, which would honestly be, in terms of deposit growth, that would be an improvement in sentiment if we get to that kind of neutral-ish level. The interest rate risk profile, I wouldn't imagine that it would change many from most, or it would change rather slowly, because we wouldn't really see the acceleration of asset cash flows and to be determined on deposit side. In a hard landing, as we might all expect, credit would be probably be the concern. We would see a sea change in the liquidity profile, as well as the move from liability sensitive to asset sensitive. But I think it would be a be careful what you wish for type of scenario, because we all remember that in terms of core spread margin business, that those 0% rate environment really can be challenging. It's the asset repricing effect. And as we saw in 21, 22, and 23, when rates are down and then they come all the way back up, the durability of our deposit franchise gets tested to varying degrees. And then the higher for longer. I purposely put the word pressure in the last 5 categories here, because as we know from the last year or so, it's the inverted curve, the higher for longer expectations, challenges pretty much every side of the balance sheet, and again is a suboptimal set of circumstances. So a couple things before we get to the funding side that Derek will kick off. But as he alluded to before, when talking about the lending side, we had the good fortune of talking to a lot of people and getting a lot of qualitative color and insight from you all, as opposed to just the purely quantitative side. And what's been interesting, we certainly have seen and heard folks who have purposely tapped the brakes on the lending side, being a little bit choosier. But we haven't seen too much spread widening in terms of the loan rates. And it's interesting, because we're in a tight liquidity environment. We're in an inverted yield curve environment. We're potentially at the end of the credit cycle. One way to adapt to that would be bumping up spreads a little bit. So, I think that speaks to the competitive forces that are here in the New England area. Certainly, as we speak with colleagues at other home loan banks across the country, that tends to be a common theme, that loan demand doesn't fall off a cliff like it does elsewhere. On the investment side, I'll sympathize that it can be challenging. That as much as there may be opportunities in terms of the high rates, the high spreads, the ability to customize the cash flows, to meet your balance sheet needs. That all sounds great, but investments have had a front row seat to a lot of the interest rate risk and liquidity risk challenges over the last year or two. So it is very counterintuitive to say, well, we're going to lean in to do things in the investment portfolio, given the set of options in front of us right now, when they have, like we said, been at the scene of the crime, for lack of a better way to describe it. And on the deposit side, differing minds, but is that CD to non-maturity deposit migration over? Your guess is as good as mine. I would like to think that it plateaus at a certain point, that we've seen 6 to 8 quarters of the folks who are going to switch have switched, and that'll adapt as time goes forward. But the fact that now potentially the clearing rate for bringing in new deposits doesn't have to start with a 5 handle. It can maybe start with a 4. Maybe that allows some ability to test the elasticity and the sensitivity to the prices from your depositors, which would help provide some funding relief.
Yeah. So as we're going through all this, we're always thinking, what do our members need? How can we help them? And we came up with some ideas of how our members can use some of our advances. We'll go through 3 different types real quick. Floating rate advances. We have 2 different types we'd like to talk about. Gives you the ability to kind of ride out interest rates for whatever term you want. The puttable advances, they seem to have a lot of value right now, especially in this declining rate market. We've seen a lot of value and good options there. And then the classic advances are always a solid choice, pretty clear cut, but I think there's options for everybody there. So what we'll go over here are the SOFR SOFR callable and the discount note auction floater. DNA for short, and that's what I'll go with for this time forward. So with our SOFR floater, it's a callable bond, callable. So you have the option to call, in this case, after 3 months. So if you look at the 6-month, 3-month callable SOFR, you have the option at 3 months, and if you're willing to, you're able to call that. Benefit is that you can ride with the yield curve, just figure out where it's going. In this case, if you're expecting the Fed to cut rates, a 3-month callable will get you through the November session. Possibly deposits have gone up for you. You have other funding options. You can simply call it with no prepaid penalty, and you have more options at that point. But it gets you through kind of this kind of unknown session through November. So DNA floater gives you a similar option to call, but it gives you very lower upfront payment, and the rate's a little bit better than trying to do the classic advance or trying to roll on a daily basis. Really gives you some more flexibility and options, especially when it comes to liquidity, because you can stretch out the term as well if you decide to.
I think that last point is an excellent one. And so, if you're currently rolling short-term advances or thinking about it, to plug a gap, take a look at these because they do give you that 100% beta to your funding, which is a great thing in a down rate environment. But as Derek said, you owning the option gives you the flexibility to give it right back to us if all of a sudden we can get into a world where you can bring in deposits at 2 or 3%. So the puttable advances, we've talked about them for a bit, and as long as the yield curve is inverted and long as volatility and uncertainty is high, they're going to continue to present value. And with the recent rally in intermediate term rates, we've seen the coupons come down pretty sharply and even cross over into different handles that jump off the page a little bit. So if you look at some of the longer structures, the 7 and 10 year structures, they've moved from being at 3% rates to now having 2% handles on them. Which creates an interesting dynamic. But then even the shorter structures that mitigate some of the tail risk, like the 2-year structures, have broken inside of 4%. So there is again some continued value there as well. Where we've also seen interest pickup of late is in the SOFR flipper advance, very similar to the HOB option advance, with the key difference being that instead of being fixed rate throughout, it's floating for the initial period. So you would get the benefit from an aggressive drop in rates in terms of how dynamic it is in terms of the change in pricing. But again, because rates have gone down, the back end fixed rate coupons are at more manageable levels than they have been over the coming months. So always happy to discuss this. We recently put an article on the website about that shares a little more insight. As always, reach out to us or your relationship manager. Always happy to have those types of discussions. Derek mentioned the classic advances, and this is one big thing that we've been talking about a lot with folks. When you have an inverted curve, the quick executive summary here is that the longer term rates are implying where they think short term rates will be in the future. So when we see an example like the 1 year rate coming down into the mid fours, we can extrapolate and say, well, what does that mean? What is the market pricing? The classic rate, the short term classic rate, what would it be in months 10, 11, 12 from right now? And it recently broke through 4%. So it's implying, it's building in, it's pricing in those expected rate cuts and the change in the rate term structure. Whereas the current 3-month rate is still in the low to mid 5. So there's a couple different ways that you can take advantage and capture what is already expected in terms of what is priced into the yield curve. First one would just be a simple modest extension. So if you're rolling short-term advances, you're at 1 or 3 months, you nudge out the curve to the 6-month or the 12-month mark. You're going to save on interest expense immediately. And again, you're not going to necessarily miss out on the future rate cuts. You're baking it in and borrowing across the full term. The second one is something we've talked about before, forward starting advances. You'd be able to take advantage of current market conditions and rates, but have the funds disperse at a later period. And the two primary ways where folks have used this funding has been to pre-replace CDs, the larger CD book that many of us now have, but also funds coming to the end of the Bank Term Funding Program. And the last idea, something that's been off the radar for a while, but those of you may have been familiar with from 2021 and 2019, at least as long as I've been around. It's dependent on the path of rates and the level of rates, but it's advanced restructures. So you'll see some more stuff from us over the coming weeks and months related to this, because it now has come back into view a little bit, but it gives you the ability to modify an existing advance, maybe something that you have at a 5.25 rate with 6 to 12 months left to go, and you can modify that advance into a new advance, and you get a couple benefits. You lower cost of funds immediately. You mitigate interest rate risk by moving out the curve. The strategy is often referred to as blend and extend, and importantly, there's no prepayment fee that hits in the current income statement period. That whatever implied prepayment fee there is gets blended into the coupon as you extend out to a further term. So there may be some margin enhancement benefits. There may be some interest rate risk mitigation benefits, and there's some liquidity risk management benefits as well. So again, take a look at your existing advances. We'll do the same. Feel free to reach out for us, and we have a report that we can run in a matter of seconds that can tell you what what the potential may be there. So that brings us to the end. We were the new record, only 3.5 minutes over our allotted time. So we'll give Derek the props for that, for keeping me in line and doing a lot of the heavy lifting. So as always, thank you very much for joining in. We appreciate the partnership, and this is always an enjoyable thing for us to do, to be able to take a deep dive into what's happening across our membership. So we're not hard to find. So if there's anything we can do or be of service, and you'll get these slides in the recording afterwards. So if you found any of the slides or content interesting, you can share it amongst your group as you see freely. But thank you again. This is a pleasure, and hopefully we'll speak to you all soon. Bye. Thank you.